People have been asking me whether it's time to get more aggressive with regard to stock purchases. I personally have not gotten aggressive yet, and I'm still keeping a considerable amount of cash on hand. The reason for this is the Federal Reserve, the Fed, has announced it's going to start quantitative tightening next month. Quantitative tightening is the reversal of quantitative easing, which began back in 2008 and accelerated with the doubling of the balance sheet during the COVID crisis. So the past 2 years, the Federal Reserve's balance sheet has doubled as they did another massive round of quantitative easing. But over this period of 14 years, from 2008 to today, the Federal Reserve balance sheet has gone from $8 billion to $8.9 trillion. That is an 11-fold increase. The magnitude of that increase is just astronomical. It is hard to fathom and get your hands around it. The total size of the U.S. economy is around 23 trillion, and the Federal Reserve balance sheet alone is 8.9 trillion, producing cash for the system. It's a bizarrely big number. So here we are. Quantitative tightening is supposed to start. It has not started yet. I've been watching the Federal Reserve balance sheet for the past couple of months, and we basically have peaked out at $8.96 trillion, but we have not started going down yet. We did stop growing the balance sheet about a month ago, so we are prepared for a situation where tightening begins and the Fed starts to take out $80, $90 billion a month off its balance sheet and drain liquidity out of the system. What one should note, and even in the face of a no longer growing balance sheet, stocks did run into a difficult period, and I would expect the lower liquidity to further have problems where that liquidity is not available to stocks, to stock purchases, and stocks could and should probably continue to weaken here, especially if inflation continues to run out of control and interest rates continue to move up. So the bottom line is quantitative tightening is ahead of us. We have not even started the process. The whole discussion with regard to the Federal Reserve rates and raising short-term rates, they have started and they've done a 50 basis point increase. That is the expectations, but the reality is as long as the Federal Reserve rate is below inflation, the Federal Reserve interest rate is not tightening. It is still loose. So even though we've had some raising of the rates, it's still very much in a loose mode on the interest rate side. We're about to start tightening a little bit on quantitative tightening next month. That should have a bigger impact. I would not really expect to see much of an impact from the short rates that the Fed can control impacting the real economy until they got to 4 or 5%. We are way away from that, and that is a probably 2023 issue if inflation continues to run out of control. So stay cautious, keep some cash on the sidelines, and make sure that anything you're purchasing or holding is a good value. The SPAC stocks, the stocks that are giving away all their profits and more in employee-based stock compensation, you need to continue to avoid those. Those will continue to go lower. Many of these SPAC stocks are going to zero as they burn through capital. Some of the no earnings companies are also going to go to zero, and you need to be very careful that you don't have those in your portfolio. Make sure your companies are generating real profits, real cash flow, and they're not concealing the fact that they're giving away all of your profits to their employees with stock-based compensation. That does not help you. If you want to go work for one of those companies and pick up some stock options, go for it, but don't buy the stock. So we still have further to go on some of these speculative names that could easily go to zero. Stay away from those. Make sure you're buying real companies with real cash flows, real free cash, generating real profits. This is Ben Halliburton. Please check out our website, buildingbenjamin.com, where you can also sign up for our email alerts. We'll get information even faster. We hope you enjoy this video. Please remember, this is not investment advice. We do not know your specific situation. Thanks in advance for your time.